At the same time, during the 70s, world oil pricing shock led to very high global inflation, higher interest rates, and even steeper yield curves. There was a large surplus of dollars outside the US, which allowed the Eurobond markets to develop and made it even easier for those who didn't really understand the risks to go and borrow. And initially, when they were borrowing in yen and dollars, they sold those currencies and bought New Zealand dollars, which supported the New Zealand dollar and, in fact, reduced the servicing costs. And it all looked very good. But without any idea of the risk to this borrowing, the lower foreign exchange receipts from reduced exports led to more foreign exchange borrowing, external borrowing. Higher gross debt levels put downward pressure on the New Zealand dollar. That led to higher debt service costs and gross debt stock. And this led to the biggest shock of all for New Zealand, was a sudden drop in the sovereign credit rating. Nobody at that time assumed that a country like New Zealand, which was managed well, could be anything but AAA. Almost every developed country in the world at that time had AAA ratings. And that drop in the credit rating led to another shock fall in the dollar, New Zealand dollar, and that went back to 3, which led to higher debt service costs. And so they came into this vicious cycle of increasing debt service costs, increasing gross debt stock, increasing fiscal deficits. At the same time, global interest rates were rising sharply at the end of the 70s. Paul Volcker at the Fed battled inflation and pushed interest rates up sharply. And their borrowing at short-term maturities continually became more expensive as they rolled over, leading again back to number 3. Contingent risks, which hadn't been understood, analysed, or recorded even, suddenly crystallised from New Zealand SOEs, from the state-connected banks, and for quasi-state-connected financial institutions. There was a very large pension fund or institution which went bankrupt at the time, and it had huge borrowings and financial derivatives in the international markets on the assumption that because it was a pension fund for civil servants, it would be guaranteed by the government, even though that wasn't explicitly stated. So all these risks affected the sovereign credit rating and increased this vicious circle. The result was a major fiscal crisis leading to change of government, the abandonment of the subsidy policies, and the need for a professional understanding of debt-related risks and their management. And this led to the formation of the New Zealand Debt Management Office, formed in the New Zealand Treasury, amongst many other wide-ranging public financial reforms. You may have heard that many of the public financial management reforms of today stemmed from these reforms in New Zealand. There was a huge shake-up, and it led to the importance of the concept of never waste a good crisis. The crisis really pushed these reforms to the fore. The NZDMO formulated this objective to then include the concept of risk. Risk management principles were devised, which sought to analyse the sovereign exposure to debt as a portfolio, rather than concentrating just on individual loans serviced, taken out when necessary. This led them, coincidentally, to employ me, because I had been managing debt portfolios, but asset portfolios. So what they wanted was somebody who could look at a fixed interest portfolio, but not from the asset side, from the debt side. And that's what we did. We set that up. And eventually that led to a broader concept of asset liability management, so that you could include the sovereign assets as part of this whole risk profile and put them together. And we'll look at that later on, obviously in the concept of the MTDS. So that led to these principles being developed, and the portfolio risks were separated into market-related risks and operational risks. Market-related risks are foreign exchange risks, interest rate risks, rollover risks, liquidity and credit risks, and we'll go into more detail into all of those later on. Operational risks were also very important, particularly from a country at the end of the world like New Zealand, when it was dealing with international markets and understood that it needed to have systems that were robust, communications that did not fail, legal risks which could be managed, transactional risks such that the personnel in the NZDMO knew what they were getting into when they made transactions. Key person risks. Couldn't really have a very, very specialized person in the debt management office, and he was the only one who knew what he was doing. And security risks, of course. A lot of other risks involved in the setting up of a debt management office. And a database of contingent liabilities was established because it was clear that when these suddenly arose, nobody had really thought about them as a potential risk. So management of these portfolio risks implied appropriate principles, which were the modeling of portfolio outcomes under likely and worst case scenarios. This was in order to measure the type of risks that you were looking at. The medium-term debt management strategy, the MTDS formulation, which put bounds on those risks and said this is the best strategy you have in the medium term to manage the risks of the debt portfolio. An annual borrowing plan, which was linked to the budget deficit, if any, and cash management, so that the MTDS was 3 or more years, but you still had to have a plan of what you were going to do in the current fiscal year. That depended on the budget deficit, and it depended on how cash flows moved through the government bank accounts. Domestic government securities market development was very important because at this stage we didn't assume that you could just go out and borrow as you wished, as necessary, because you didn't have a AAA rating anymore, even in your own market. And in the international markets, you had to maintain your professional credibility and you had to manage your credit rating as well as possible. You needed to separate fiscal management from monetary policy operations, and this was a very important factor. In markets where you want market liquidity, you want deep understanding and trust from the market participants and the investors in this case, they need to know that the government is not taking advantage of the inside knowledge that it has about monetary policy. For example, an investor does not want to fear that the government will issue a large domestic bond, expecting him to buy it just before the central bank puts up interest rates. So you need to get an understanding that fiscal and monetary policies are independent, even though they are clearly coordinated by the government. Talking about the operational risks, you need secure database systems and very secure settlement procedures, again. talking about periods before the internet existed. Everything was done by fax and by phone when we were dealing with the London and New York markets. We needed to be absolutely certain that where there was no risk of default in any of these operations. We needed a lot of capacity building with financial market and analytical skills. These, as I mentioned, were certainly not available in the political arena, and at the time they really weren't available in the Ministry of Finance because it had not been concentrating at all on debt management. It had been concentrating on economic management, and it needed appropriate human resource policies to maintain the skilled staff. For example, I was brought in on a salary which was the highest civil servant salary in the country, because I'd been brought in from the private sector. And as we trained up people in financial market and analytical skills, they were constantly being headhunted by the private sector. We needed policies that would ensure that they were retained. So we've talked about the key risks to the public debt portfolio. These are the risks that need to be managed in some way. They need to be modeled, modelable, and they need managing. The three key risks are refinancing risk, which is the ability to refinance and roll over maturing debt and new debt. Interest rate risk, which is fairly understandable. You in a fixed interest environment, you issue at some point on the yield curve, and that's the fixed rate that you will be paying until you roll over. In floating rate bonds, their interest rate changes every 6 months or 1 year, and a reset. And the foreign exchange rate risk, which is what I was describing particularly in the New Zealand example. The whole debt portfolio is subject to enormous foreign exchange volatility, which has a very large impact, not only on the size of the debt portfolio, but particularly on the debt servicing requirements. So refinancing risk refers to the uncertainty that debt may have to be rolled over at an unusually high interest cost or cannot be rolled over at all. And this is typically a problem for countries with volatile or deteriorating economies. So where an economy is looking very poor, there is a possibility that the government will not be able to attract investors. Investors may not have the liquidity to fund the government at all. And foreign investors may be fleeing the country and selling government debt rather than buying it. So refinancing risk is certainly related to the state of the economy, the state of the international economy, and the state of the political environment in a country. Measures of refinancing risk include the share of debt falling within a specific time period, so that's the shape of the redemption profile, and the average time to maturity of your debt portfolio. And where you have large maturities suddenly appearing, you need to manage those so that your risk is managed, and preferably you have a long, like in the second graph, a long, relatively smooth distribution of redemptions or maturities of your debt portfolio. And this allows you to be fairly confident that you won't be shocking the market by saying, I need to reinvest or roll over this very large bond which is maturing today, and I need you all to invest in it today as well. So the redemption profile is a reflection of the funding sources, the market access that you have at any one time. Interest rate risk is the potential debt service changes due to future movements in domestic and foreign interest rates. So that if you have a bond that is maturing and you need to roll it over, or you need to borrow new money, that is subject to what the interest rate is at the time you're doing that. And if you have borrowed at a much cheaper or much lower interest rate in the past, when that bond matures, then you might need to have to pay a much higher interest rate all of a sudden. So the measures to your interest rate risk are the amount of debt exposed to interest rate refixing within a specific time period. So you look at your time period, you say, within the next year, or within the next 6 months, or within the next 3 months, I have this amount of debt that is maturing, and I have this amount of floating rate debt which is refixing. And you need to measure that. Another measure is the average time to refixing. So if that amount of debt that needs to be rolled over or refixed is in 5 years' time, you have less risk, interest rate risk, to that portion of the portfolio than you would if it was going to mature tomorrow. And the variable rate debt ratio is another measure, so that if you have very high proportion of floating rate debt, by definition that will need to be refixed at a shorter time period, closer to the present, than if you had long-term bonds. And so the higher your variable debt ratio is as a percentage of your total debt, the higher your interest rate risk is. Foreign exchange rate risk, as I say, is fairly clear. It's associated with the volatility in interest rate in exchange rates, and the impact of that volatility on interest and principal repayment costs for any of the foreign currency debt in your debt portfolio. In many countries, it's one of the principal risks in a government debt portfolio. The one thing that we did in New Zealand was we tried to ensure that these large foreign loans and bonds that we had inherited were either paid off or hedged as soon as possible. Now, it's always a trade-off, and you'll see that in anyone doing a medium-term debt strategy modeling. Normally, in many countries, domestic interest rates are higher than foreign interest rates. And like the New Zealand Prime Minister of the 70s, it's very tempting to go into the Japanese yen market and say, I can borrow at 1%. Whereas if I have to go in my domestic market, I can only borrow at 6%. It seems like a no-brainer to go and borrow in the yen rather than local currency. But you need to weigh up that foreign exchange rate risk. And measures include the ratio of foreign currency denominated debt to the total debt, the currency composition of the debt portfolio, because obviously the foreign exchange rate risk of some currencies is less than others, and the degree of currency mismatch. And this is where asset liability management comes in. You can do this in a rough manner or a fine detail manner, but the more developed in your debt management you get, the more you will need to start thinking about how the currencies of the government that it's exposed to relate to the currencies of your debt portfolio. And this is particularly appropriate in Nepal, where you do have a lot of foreign currency inflows, which can offset the currency risk of the foreign currency debt that you have. And so you need to look at the government inflows in foreign currency. The central bank reserves are an important area. If they are large and they are held in particular currencies, they will automatically offset foreign exchange risk of the debt portfolio in a time of foreign exchange volatility. And of course, another point which is particularly appropriate for Nepal is the degree of synchrony with the hard currency economy. So if your domestic currency is either linked, fixed, or for some historical reason, very closely matched to movements in another particularly larger economy's currency, then you can use that to say, okay, I can either hedge into borrowings in that currency or see how that currency is related to movements in the international foreign exchange market. Contingent liabilities and fiscal risks, they need to be managed. They need to be understood, first of all, and they need to be recorded, and they need to be managed. They represent potential financial claims against the government that have not yet materialized, but could trigger financial obligation or liability under certain circumstances. And the obvious example is a government guarantee to an SOE or a local authority. If the SOE has borrowed in Japanese yen and the government has guaranteed to the supplier of that loan that it will step in if the SOE defaults, then the government has the potential for all that interest rate risk, that currency risk, that rollover risk, and it needs to understand that it bears those risks in the case of the SOE defaulting. And fiscal risks also have a big impact on the debt situation of the country. So macroeconomic shocks, natural disasters, as you know in Nepal very well, and the realization of contingent liabilities form a fiscal risk. One of the really big problems that happened in New Zealand in the late 80s at this time was that a state-owned bank went bankrupt and the government had to bail it out. And this caused huge repercussions in the budget, the fiscal stability of the country, and of course the banking system. So it was not only a problem for the government, it was also a problem for the central bank. Mr. Sabadi has asked whether I can talk about key person risk. Key person risk is, I'll give you an example. I find it fairly amusing. I went to a country in Eastern Europe where they had a huge number of debts, bonds, loans, various sorts. And I talked to the manager of the debt management office. And apart from the settlements, he was the only person who knew what debts of the country were. He had stacks, piles of files on his desk. His office was covered in security blocks everywhere. Nobody was allowed in when he wasn't there. He knew all the terms and conditions of all the loans, and nobody else was allowed to know these. The computer system only had very short-term debt servicing elements so that they only knew that certain debts were coming due within the next, say, 3 months and nothing further out. Only he knew these. So we said, what happens when you retire? What happens if you decide you want to tomorrow go off and live in another country? And he said, yeah, this is a problem. You know, I'm not prepared to let my staff know about these things. We said, this is key person risk. You know, if you drop dead tomorrow, if you get run over by a bus, there is a real problem to the country of nobody knowing what the debt portfolio is. So I went back about 2 months later, and he was all smiles, and he said, I've solved key person risk. I've got a deputy, and she knows everything that there is to know about these files and the debts, and she knows as much as I do. And I said, yes, that's good. That's good. I mean, only one extra person is probably still a risk, but that's good. Who is that person? You know, will they be around if you're not around? He said, maybe not. It's my wife. So this, I hope, sort of gives you an illustration of what key person risk is. If you have somebody with very, very specialized skills, an example can be somebody who really understands the domestic debt market, who interacts with the investors, who interacts with the banks, understands the auction system very, very well, can realize when the most appropriate time is to issue debt and when you shouldn't be issuing debt, this sort of thing. If only one person knows that, that is a key person risk. Because if that person dies, goes abroad, just retires, you haven't got anybody else. So it's really an idea of capacity building, spreading key person risk, and making sure that a lot of people know exactly what is going on in the debt management office. Other risks consider a liquidity risk. If the domestic market, for example, just dries up and the economy really is very poor, say inflation is coming back dramatically, no investors want to invest in fixed interest bonds because they know that interest rates are going to be rising sharply, you have a serious liquidity risk because you will not be able to either roll over your maturing bonds or issue new bonds at all. Counterparty credit risk is normally not much of a problem except for more developed countries because they're more associated with assets. So if you have a counterparty that you have lent money to, the counterparty credit risk is the risk that they will default on the money that you've lent them. Many governments lend and on-lend money to SOEs and local authorities, but they believe that the counterparty risk is low because basically they own the company or they control overall the political risk of the local authority defaulting. So there's very little credit risk there. If you are managing financial assets, particularly, for example, cash management, if you're doing active cash management, it means borrowing for short periods when you expect cash shortages, but also investing for short periods of time when you expect cash surpluses. And you need to be aware that if you're investing that cash in the banking sector, you need to understand that there is a risk that those banks can go bankrupt, can default on repaying your investment. Derivatives similarly have fairly complex counterparty credit risks that need to be understood. Legal risk. Many governments face legal risks. either directly related to debt management, in which case we're talking about the legal aspects of the transactions, and these can be fairly complicated in the case of derivatives, or wider, where the government may be at a fiscal risk because somebody has taken it to court and it could end up paying a very large amount, which was unexpected. And as I mentioned, operational risk refers to a wide variety of risks faced, which can disrupt efficient debt servicing and government financing. The paramount 2 points that a debt management office needs is to know, A, that the government does not default on its debt servicing, and B, that it finances budget requirements as necessary. So if there are operations which put those 2 points at risk of being disrupted, they must be managed. So that sums it up. The key message is you need a clear objective which highlights risk management, not just the cost. The debt management principles relate to portfolio market risks, market development, credit standing, operational risks, and very importantly, capacity building in order to maintain these management capabilities. And underlying all this, the means through which portfolio risks can be understood, analysed and managed. In other words, it's one thing realising that these risks are there, but you need to measure them. You need to understand how they may crystallise and how you can manage that risk. Good, thank you very much.
Yes, thank you, John, for a very good presentation. And the key person risk is very impressive. But any questions from participants?
साथीहरु क्वेशन गर्नुस् न प्रश्न गर्नुस्
Hello, Ms. Subadi, we can hear you very well. Yeah, please go ahead.
Yeah, my question is on the market development. Based on your experience, what kind of strategies were applied by the countries to develop market, debt market? John.
Yes, thank you. What I should have said at the beginning was stressed that this is just a general overview. What we're planning is that one of the later sessions will deal exclusively with domestic market development.
Okay.
I think that it probably will be better to wait for that because it's quite a long, detailed subject.
Okay, we'll be waiting on that side. Yeah, thank you very much.
Yeah, since we have already run behind of our time schedule, if there are no any burning questions, maybe we can go to the session 2.
Right.
Kindly proceed.
Let me try again. Let's get rid of that one. See whether it works. We've got it.
Oh,
Yeah.
There you go. Great.
Oh no, sorry, that's the PDF file. No, that's annoying. Yeah, that's the PDF file. Right. Are you all okay with that?
Yeah, perfect. Please go ahead.
Right. Excuse me, I must... Okay, so the second session, where are we? We're talking, yes, hopefully half an hour, I think, and then we'll get some questions if necessary. The role and function of a debt management office. We've been in a general overview of what is the objective of debt management. So who does it? How do they do it? Why do they do it? And the World Bank and the IMF produced a set of guidelines for public debt management in 2001. And that brought together a lot of the experience that had been found in places like New Zealand, the UK, which set up its debt management office in the late 90s, Ireland, various other countries started to set up debt management offices. And New Zealand, we had been through a lot of the private sector, the portfolio managers and the banks, to work out how to structure an institution that was designed to manage portfolios and manage portfolio risks, whether they were assets or debt, really made no difference. And we decided to give these names to the offices within the debt management office, and their names have stuck. I mean, they're typically what a commercial bank would call its offices. So you have the front office, middle office, and the back office, and you're very aware because you use these terms very well. And the guidelines state that once the DMO is separated into those offices, they should have distinct functions and accountabilities. There's no real problem with their interaction in general, except one specific area where the working unit executing a transaction and the one responsible for maintaining the debt recording and the accounting system should be separate. And there have been in very, very many instances, particularly in the private sector, where you've found that the manager responsible for front office activities, in other words, dealing with the markets, is also responsible for inputting information into the settlement systems. And that can lead to all sorts of conflicts of interest and fraud. And therefore, that wall should be set up that there should be no possibility that front office people can have direct access to altering anything in the data recording and systems, settlement systems, or accounting system for that matter. So these guidelines have been generally accepted and followed as countries set up PDMOs to develop a consistent risk management framework. There are different international institutional arrangements. Generally, what you want is a debt management office with operational independence, some form of independence from the general Ministry of Finance economic policy making. It's a different task. It requires different skills. It requires more market-sensitive skills and dealings. I don't know why that happened. And therefore, it needs certain amount of operational independence. And that has led to it having a core responsibility of managing the debt portfolio, but also these other responsibilities can be brought into the debt management office, often including cash management, which we talked about yesterday, and I'll talk about that more when we're talking about annual borrowing plans later on tomorrow. Sometimes DMOs have asset management responsibilities other than cash management, so that if particularly financial assets are held by the government, which are not just pure in equity investments in SOEs, for example, but are more liquid financial assets, they can be managed by the debt management office because of its skill set. Often contingent liabilities are managed by and on lending are managed by the debt management office because of their fiscal risks and because of the financial understanding of the debt management office. So that where you have a contingent liability, so a loan to an SOE, when I talk about managing that, I'm not talking about having the skills in the debt management office to understand if the SOE is going to go bust or not. It is not the responsibility of the DMO to say, I think that SOE is going to default on its loan. But it needs to have a database which has the understanding that that contingent liability exists and what the repercussions would be if the SOE did default. So there's a spectrum of institutional arrangements. Many countries, it's a specific part of the Treasury or Ministry of Finance, or in another ministry, sometimes the Ministry of Planning. These are less independent. They tend to be very much wound up with the economic policy makers. A separate status as a Treasury Bureau, again, within the Ministry of Finance, but very independent. Sometimes in, for example, Finland, the debt management office will have complete independence, even though it is within the Ministry of Finance. Semi-independent agencies, such as New Zealand, Australia, Netherlands, UK, where it may be in the Ministry of Finance or as an agent of the Ministry of Finance, such as in the UK, but has very strong reporting lines through the Ministry of Finance. An agency within the central bank. Now, it works in Denmark and Iceland. I've seen it work particularly in Iceland, and it is strongly bound up as an independent agency within the central bank, and they make it very clear that there is no interaction between monetary policy and fiscal policy in this regard. But other countries where it is within the central bank, I've seen many developing countries in this case, and there is no such clear distinction. And in fact, monetary policy operations combined specifically with fiscal policy operations, and there is confusing, the market is confused. And to a certain extent, even though you're now setting up your independent debt management office, you can understand what I'm talking about, where you have the central bank operating the domestic debt management within its monetary policy operations. Semi-autonomous agency within government, that is, in other words, outside the reporting structure of the Ministry of Finance, such as Sweden, Ireland, or sometimes a company wholly owned by the government. And this is effectively set up almost as a bank to run the government's finances and market relations. Some, and I would say most, use the central bank as their agent, because the central bank has, as you said yesterday, the contacts with the banking system in order to have more feel, but also quite a lot of control over the domestic fixed interest markets. And all of them use the bank for certain services, such as obviously the government banker and the TSA. Can't read it. International framework. Oh, there we go. International framework for public debt management. So the framework has to be able to develop the necessary skills and experience, which are, as I mentioned, very independent, very different from the normal skills and experience needed in a Ministry of Finance, which relate specifically to economic policy. So that this suggests the formation of a comprehensive standalone debt management function, the DMO. And we do recommend that it has a fairly large degree of autonomy, even if it is strictly within the reporting structure of the Ministry of Finance. It needs to have its independence specified so that it's separate from monetary policy, so that it's separate from the Ministry of Finance accounting function. Now, some countries, they're very, very close. This, I think, tends to be a mistake, because you tend to get the accountant general or the equivalent taking control of some of the autonomy of the debt management office, when there are different skills required. There's a separate database as well, and there are also security concerns which relate to what I was talking about, of separating the transactions from the data recording. It's preferable that the debt management office is combined with the cash management function. They need to be very strongly coordinated, and when sufficiently developed, the debt management office can take over cash management. What I mean by that is cash flow forecasting is a very complicated task, and when it's being developed, it's normally developed by the accounting function, because they run the systems, the accounting recording, and the bank accounts through which all the government transactions flow. So they have all the information about how cash flows are moving, and therefore they should be able to be in the better place to forecast how cash flows will be. Since cash management only looks at the current fiscal year, they should be able to forecast how the budget is going to be executed over the current budget year. Once you have that, and it's difficult because it needs forecasts from every ministry, every line agency, every entity that has any involvement in budget transactions. Once you've got all those forecasts and they are reasonably accurate, then you can go into what I call active cash management. And as I said, active cash management is market related. It means borrowing for the short periods of time when you expect to have shortages, and investing for the short periods of time when you expect to have cash surpluses. And those skills reside in the Debt Management Office. So the conclusion is, for an institutional framework, it's usually a standalone unit within the Ministry of Finance, or perhaps an independent agency reporting to the Ministry of Finance. As you're very aware, the legal framework for public debt management is very important. It's necessary to support DMO operations and its oversight. And it has to be very clearly understood by everybody. And that doesn't just mean the hierarchies within the Ministry of Finance or even the politicians, but because the Debt Management Office is responsible for all market-related operations, the whole of the domestic and international finance markets have to understand that the Debt Management Office is credible from a legal perspective. So it needs to establish the DMO as a specific government entity. People need to understand that the DMO is acting on behalf of the government. It needs to define its functions, and it needs to provide it with the requisite authority. As you know, legitimate day-to-day activities of the DMO can lead to or be associated with a risk of significant losses and costs to public funds. There are instances, they hit the headlines in Australia fairly regularly, where the politicians, particularly the opposition politicians, are looking at exactly what the Debt Management Office is doing. And as soon as, say, a currency hedge goes wrong, it hits the newspapers. The Debt Management Office has caused us these huge losses without sort of understanding that it's a hedge and there are gains on one side and losses on the other. These need to be dealt with on a legal basis, and the Minister of Finance needs to be able to stand up in Parliament and say, no, the Debt Management Office is perfectly legally entitled to do these risk management transactions on behalf of the government. So the DMO must not only be, but must be publicly seen to be legally authorized, monitored, and accountable for its actions. So if it has taken out a position in foreign currency markets, which it didn't have authority to do, say it was only allowed to do foreign exchange transactions which hedge its foreign exchange exposure. If it said, okay, I think that the yen is going to go up against the dollar, and for no reason it decides to buy a lot of yen, then that has to be monitored, and the Debt Management Office legally must be accountable for any losses that arise. Now, this requires high-level legislation. So often in the Constitution or in what we call an organic Public Financial Management Act, which is much more general, much broader than a specific budget. This somewhere provides the Minister of Finance as a specific person, individual, with authority to borrow on behalf of the government for specific purposes. And then, in some form, that authority needs to be clearly and in a binding manner delegated to the management of the Debt Management Office. Lower level legislation, then typically a Public Debt Management Act or regulations in some countries need to specify the tasks, the functions and the restrictions required of the Debt Management Office. So these must include the governance and institutional structure, which is the establishment and the role of, including this establishment and role of the Debt Management Committee, which in certain instances, certain countries, can be just an advisory body, or in others is much more authoritative and has a strong management role from a very high level. So it's a spectrum. It can either be just purely advisory, or it can be required to approve all sorts of decisions and operations that the DMO is making. The legislation needs to describe the instruments and activities that are permitted, and this can be obviously fairly clear as in the case of just pure bonds and loans, but then can get quite complicated when we're talking about buying derivatives, involved in derivative markets, or in fact in buyback operations to control the risks. The reporting requirements to internal Ministry of Finance, Management and Parliament need to be defined. The medium-term debt strategy, for example, the annual borrowing plan, and the outcome performance reports of the DMO need to be defined as these are required to be laid before Parliament. These are required for internal management, and this needs to be described either in law or in regulations. Similarly, the reporting requirements to international organizations such as the IMF and the public. It helps to know what the DMO needs to put on its website. This normally in regulations, it's not a legal sort of high-level law that requires this, but regulations should state that the DMO needs to give this information about what it's doing and what the debt portfolio is doing to the public. Legally, the DMO must be subject to internal and external auditing requirements, and in some cases, a debt management office advisory board is set up, which includes external experts, and this will give advice to the debt management office and will be structured formally in law. Going past the legal framework, there is a relationship framework for public debt management. Debt management activities are both complex and wide-ranging. They're often difficult to understand for government senior managers inexperienced in financial markets and portfolio risk management. The Debt Management Office needs to maintain its authority and its credibility by being able to clearly state what it's doing and why it's doing it to senior managers in the Ministry of Finance, to politicians, to Parliament, and, as I said, to the public. And these activities require the understanding of relationship management. Debt Management Office also interacts with many parts of government, and therefore, if it needs information, it needs to be able to have the authority to go to where the information is and ask, or if necessary, demand that information. So it has to have good relationships with particularly the macro-fiscal function, which is usually in the debt management, usually in the Ministry of Finance. The budget department, because financing the budget is a very large and important part of debt management. The accounting function, because settlements and debt servicing are very interlinked with the accounting function. Project management and concessional financing functions. Normally, a debt management office would expect to be able to say, I want to borrow in this market, I want to borrow this much, and I want to borrow at these terms. But obviously, particularly in developing countries, and this is very clear in Nepal, there is a lot of loans and debt raised either on concessional or non-concessional terms, which are directly related to project management. The Debt Management Office needs to know what those are, what their terms are, and incorporate them into the debt portfolio, because they are very important parts of the overall debt portfolio and its risks. To a certain extent, local governments come into that as well, because some countries, local authorities are allowed to borrow in their own name. Some countries have explicit central government guarantees on that. Some have implicit government guarantees. In many cases, there are very grey areas relating to local governments. This has been a huge problem in China, for example, where local governments have strictly not been allowed to borrow in the past, but have found ways around doing that and have raised enormous debts, which have absolutely no monitoring or understanding or recording in the central government debt management function. Similarly with SOEs, exactly the same. If there are SOEs that are borrowing with government guarantees, if you're on lending to SOEs, etc., this needs to, there needs to be a relationship between the Debt Management Office and the part of the Ministry of Finance that is overseeing the SOEs. And of course, very, very strongly, there needs to be a good relationship with the central bank, and this is often a very difficult area of contention. So this sums up the external relations. At the bottom, we're talking about the central bank, line ministries, subnationals, SOEs, etc. The governance is the Ministry of Finance, the Minister of Finance, the board, the DMC, and then reporting to Parliament, the media, and the wider public. On the sides are the specific transactional relationships necessary with the market makers, the investors, and the creditors, and then the market infrastructure, so that the regulators who regulate government securities market, for example, the exchanges like the stock exchange, which trades government securities, and the clearing and settlement systems, particularly involved in international bond markets. The key elements of more formal relationships, those with the Ministry of Finance, can be internally published, particularly alongside the delegation. The central bank really needs to have a strong written contract with the Ministry of Finance for a whole raft of different areas, from economic policy research to being the government's banker, and to being the fiscal agent for the Debt Management Office. And these needs to be written down. And then, as I said, the relationships are more informal with ministries, the market, the central bank to a certain extent, and Parliament. The macrofiscal function is necessary to develop the MTDS. And Hui will be going through this with the MTDS. So it involves a lot of macrofiscal analysis being drawn into MTDS analysis. And then it's also necessary for the Debt Management Office to provide its debt strategy to the macro fiscal function, which should be performing the debt sustainability analysis on a longer term basis, which needs to have incorporated in the debt sustainability analysis the debt management strategy. What I'm always saying to countries is that constructing the debt sustainability analysis is not the responsibility of the DMO. Too many countries have, for example, a Minister of Finance who's looking at the overall institutional structure of the Ministry of Finance and is being told by people like the IMF, you must do a debt sustainability analysis. And the fact that it includes the word debt, immediately the secretary or the minister says, oh, that's the DMO. DMO does not and should not be expected to have the macro fiscal economic skills needed to perform DSA. So that should be in the macro fiscal function, and there should be a lot of coordination between the DMO and the macro fiscal function. To ensure the work of the DMO is understood in MOF and has senior management approval and backing for its policies and its planned activities, a high-level debt management committee is necessary, and you have this already planned in your institutional structure. And as you have, it should consist of the senior managers of all the relevant MOF departments, which I've talked about, so the macro fiscal, the budget, the accountant, and the central bank. And it should have the authority to call on members of senior management teams of, for example, line ministries, local governments, SOEs, as necessary. The Debt Management Committee has a very important role. It gives credibility, authority, and status to the Debt Management Office. It needs to have a lot of understanding of what the work of the DMO is, and it needs to be able to approve that work. So it needs to approve the medium-term debt strategy once it's developed. It should approve the annual borrowing plan. As before these go to senior management in the ministry and before they go to Parliament, it should be approved by the DMC. It needs to sign off all external reporting from the Debt Management Office to ensure that it is within the policy of the ministry. Where necessary, it should approve individual portfolio transactions. As I was talking about derivatives and hedging, for example, if the DMO wants particularly to do a specific transaction which is outside the normal bounds, it needs to say why it wants to do that to the DMC and get their approval. Typically, derivatives come under that heading. It needs to consider the significant external events on the work of the DMO. So if credit ratings are moving or being put on watch, if the budget changes during the year, if fiscal risks are being crystallized, including natural disasters, for example, the DMC needs to talk with the DMO about these, because the DMO tends to be in a financial markets shell, and can often, without the DMC, it can often be unaware of certain policy changes which will affect its work, and it's the role of the DMC to make sure that it is aware of those. And it needs to approve other DMO activities, such as provisioning for contingent liabilities if they think they're going to crystallize, to do cash management activities, to in-source debt management. Often the DMO takes on the responsibility of debt management for local governments or even SOEs in certain circumstances, and asset management. The DMC needs to ensure that all auditing requirements are performed effectively and that audit recommendations are acted upon. So it acts as a high-level management oversight committee as well. And it needs to report to the Minister of Finance on DMO performance. Now, I've got some tables here, which I hope you will take. We won't go through them because there's not time, but we have the primary front office functions, market analysis, pre-transaction analysis, transaction execution, relationship with agents, relationship with the market, development, market development issues. Middle office functions, strategy formulation, coordination with other policies, reporting, relationship with other key stakeholders, and operational risk management. And then the primary back office functions, the debt database, the IT, debt statistics, payment instructions. Staffing, a small debt management office can operate with about 15 qualified personnel. And this is much more a country-specific idea. Certainly fewer than that is not normally expected to cope. Greater importance is the level of expertise and the budget cost of such personnel. So front office staff clearly should have financial markets experience and training. It can be very expensive. The back office needs experience in domestic and international settlements and procedures, developing, maintaining IT systems, and producing accounts and debt statistics. Middle office needs more diverse skills, certain level of macroeconomic training for MTBS modeling and its interpretation, financial portfolio skills in order to interpret the strategy into portfolio parameters, to guide the front office in its transactions and monitor the performance of the implementation of strategy, and communication skills, because, as I say, they will be responsible for all these relationships that we've been talking about. So that's about it. The key messages: manage the sovereign debt portfolio with a clear risk management framework, a front office, a back office, and a middle office. Staff must be well trained, experienced in their roles, and motivated at all times. And these are specifically big problems where you have this policy of rotating staff around the Ministry of Finance, or you train staff up in financial markets and they get headhunted away continuously because you cannot afford to keep them. So that's it for this one. Any questions? Is anybody there?
Yeah.
Hello.
No, SP Royal here.
Hello. Hello.
Hello. I have very general question to you. From these parameters, you have reviewed our organizational structure yesterday, where you find our office over here structurally.
Sorry, could you repeat that? Where do I find your office?
Basically, we have reviewed the organizational structure yesterday.
Yeah.
You have provided us the parameters over here.
Yeah.
So I think in your report, you will definitely incorporate the strength and weaknesses of the PDMO in Nepal. And in generic term, in 2 or 3 sentences, where we stand for actually from your evaluated judgments.
I would say that you are starting very early. You're in a very early stage, and I think you have started the institutional structure very well. The Again, we haven't had the chance of looking at the translation of the Act yet, but I'm assuming that you have put in the recommendations that the World Bank made to the Act. So if that's the case, I think the Act should be very well structured now, and it gives you the authority and the relative independence of the office within the Ministry of Finance. So I think you've, in a short sentence, you've made a very good start. What is clear is that your skill capacity building is necessary to continue at a very strong level. So rather than concentrating on debt management itself at the moment, you're going to need to concentrate for some time on capacity building. And that will be necessary for you, as you said yesterday, to bring in temporary experts from the central bank, probably from perhaps the banking system, the banking sector, and obviously have IMF, World Bank technical assistance to build up the capacity. As I said, it's fairly rare for a debt management office to have fewer than about 15 staff. You have, I think, quite a few less than that. So you're going to need to develop staff. As you build skill capacity, you're going to need to build staff capacity as well. So in a nutshell, very good start, but it really is very much at the beginning.
सत्यहरू प्रश्न गर्नुहोस् न
हेलो हेलो हेलो
Yes, please go ahead.
hello you are listening me hello
Yes, we can hear you. Please go ahead.
You mention here various institutional arrangement of debt management function. In your opinion, which country's arrangement is more effective in your observation?
I'm sorry, could you repeat that again? I didn't, it's a very bad line. Did you get that?
Yeah. You mentioned various institutional arrangement of debt management function. They are front office function, back office function, and middle office function. Many countries implemented this function in integrated form, and many countries implement it in fragmented function.
Yeah.
Which arrangement is more effective in your observation?
Yes, thank you. That's a very, very, very good point. And it's one where your countries are organically growing a debt management office. And so what you have is you have all the back office functions in the accountant general's office. You have typically the domestic market in the central bank, etc., exactly as you have started off. And what they do is, as you say, they keep those fragmented areas and try then just to have a front office which has the financial market expertise. We find that is very, very difficult to operate. Every experience that I've had, all the articles which you will read from the IMF, from the World Bank, etc., will state that it is better to aggregate all the responsibilities of a debt management office under one managerial institutional structure. And the reasons for this are many, but particularly the the fact that it needs a separate database and IT system. It needs a separate policy and research area. And of course, it needs a separate financial structure, market structure, and relationship structure. But all those fit together to meet the objectives that we've been talking about. So it is an important point. And I think Nepal has done precisely the right thing. It has said, we don't want this fragmented structure anymore. We're going to bring it all together. It takes time, but it is the right way to do it.
Thank you, John. Thank you very much for these insightful remarks with us. I think we have a little bit running the time, so shall we proceed to the next paper presentation? Thank you very much, John, for the wonderful presentation. We'll be with you for days. And we'll be discussing on main time also. Thank you very much for the wonderful presentation. It is really, really helpful for us to self-assess that your presentation will be the one of the resource that can help us to assess ourselves from inside also. Thank you very much. Thank you.
Yes, thank you very much.
Yes, thank you, John. Hui, could you please start with your session?
Yeah, can you guys hear me clearly? I already put on the PowerPoint. Okay, good. Just following on that, the capacity development, I think you already put the structure and the getting the people. IMF and the World Bank have many training programs for the staff on many topics, on MTDS, ABPs, and all these effects management, external bond issuance. I think you should leverage on these training programs. We definitely can send the people to on-site once the virus is created to provide all these trainings. So that's on that. Next 30 minutes, I'm basically going to talk about how to produce MTDS. MTDS is, most countries publish MTDS in 50 or 100 pages, and they use that as a guiding principle for the data management operation in the medium term, 3 or 5 years. So what is the MTDS? MTDS is not about to achieve certain level of debt. It's about, given the level of debt, how to control the risk in that data portfolio at a manageable cost. So the key purpose is how to get the funding, what are the risks, what are the potential scenarios that will causing problem for the data portfolio. So it's basically about an action plan for the next 3 or 5 years. We can, it's similar to an analogy to if I'm planning to climb the Himalayas, I needed to do all these planning and anticipate what are the risks, and I have all these contingent plans there to deal with risks. So it is basically action plans by anticipating and managing all the risks and design the contingency plans along the way. These MTDS documents, it's going to be very helpful to improve a market confidence in the DMO. They know what the DMO is trying to do in the next 5 years, what kind of strategic targets they're trying to achieve, and what kind of operation every year they're going to do. So it will basically provide a roadmap for MTDS to control the key risks in their portfolios. Like John mentioned about the rollover risk, FX risk, interest rate risk, and these are basically MTDS. So it's the documents contain all the information about medium-term plan and the risk identifications. It's not about debt sustainability analysis. It's not about how to raise revenues, how to reduce debt. It's about given a debt level, how to control the risk, how to mitigate the risk at a reasonable cost. So that's basically its MTDS. With a published MTDS, the investors will know clearly what the DMO is trying to achieve. Also will improve the coordination with other agencies. We are going to move in this direction, so we should coordinate and help each other. So this basically provides some principles for the data management operations. All these are the areas that going to help the benefits of these. In many countries, if they want to issue bonds in global markets, the MTDS, usually they look at these MTDS, they make the decision whether, I should buy more bonds of these countries because they know the risks they know what they are doing. So it's extremely important to publish MTDS, to communicate with other agencies and the markets. It's a bigger coordination mechanism because during the process of produce MTDS, you're going to involve a lot of work with the fiscal authority, monetary authority, the market participants. So that's basically a documents all these interactions. Next one, I'm going to briefly go over the key steps to produce a good MTDS. So MTDS is basically have 8 steps. First, you decide how much debt, the size of debt you're going to finance, what should be included in the total level of debt, including explicit debt and a contingent debt. Then you decide, what are the risks currently in my portfolio? You identify the key risks in your portfolios. Then you look at what are the potential sources available out there in the next 3 or 5 years. You choose the right instruments. Then based on these, you also consider what are the macro fiscal environment, what are the trends of revenue, fiscal growth, GDP, inflation, interest rates. This is going to be the key parameter to decide what instruments you choose, where other risks might arise. Besides the macro and the policy environment, you also have to consider the structural effect on your choice. For example, the state of the local government, the state potential interest rates trend and exchange rates trend in the global capital markets. These also will set up the backdrop for your risk management framework. After all these, you identify the key risks and the potential scenario. You analyze different choices, different paths to achieve that target, and what are the trade-offs around these different paths. So you rank all these alternative strategies, then you make an informed decision. After you analyze all these alternative strategies, what are the basic trade-offs? You review it with the fiscal authority and the monetary authority, and also with the market participants. So make sure it's feasible, it's reasonable, then you publish it to communicate other guiding principles. So these are overall. Next, I'm going to go over each steps. The first step is to decide the size of the debt you're going to finance in the next 3 or 5 years, based on the projection of your own projection. Also, you also consider the projection from other authorities, because each authority might have different projections. As you said, the planning agencies, they might be too optimistic because they want to spend more money. The monetary authority might be conservative because they're afraid of over-projection will cause overheating. So you have to make your own judgment. What is the most likely scenario of the data projection in the future? Based on that, you choose the reasonable targets to finance. This also, you have to choose a scope. You only choose explicit debt, or you choose more wide, including the contingent, local government. But in most cases, government, including explicit debt, also they including the contingent liability as well, especially some are implicitly guaranteed. So you define the scope, You decide what is the right level of debt you're going to finance in the next 3 or 5 years, also with some probability of certain scenarios. So that's the first step. Second step, you identify the risk. What are the risks in your portfolio currently? There's like all the key risks that John is talking about. Firstly is currency risk. There's also interest rates risk. There's a rollover risk. These are the key portfolio risks in your debt. So you use some analytical tools. For example, the DMOS in your information system should be able to produce these key risk parameters in your portfolio. So you are aware what potentially are the risks. If the rollover risk is very high, you potentially will run into funding problems. If the FX risks are very high, then potentially the debt will be easily increased if the FX devaluate. If the floating rates are too much, then interest rates could spike, causing rising debt servicing problem. So you identify the risks, then you look at the potential sources of funding for next 3 or 5 years. How much money you are likely to get from concessional lendings, from these international financial agencies. Also, what are the potential bilateral funding you're going to get? Of course, these are very uncertain. Sometimes they might increase, sometimes might decrease, but at least you should have some idea what potentially these funding sources are going to be, what are the ranges, what the timings of the funding might come from. Also, if you are planning to assess capital markets in the future, then you also have to project ahead, really prepare a few years ahead in order to assess this. For domestic sources, you also have to plan ahead how much money you can get from the banks, how much money you can get from issuing development bonds or T-bills. These are basically, you have to project these based on the conditions of the banking sector, how big the banking sector is going to grow in the next 3 or 5 years, based on some credit growth, the GDP, the remittance. Also, you have to project the size of the capital markets based on the bond market development. The bond market is going to continue to develop at around 10 or 15%, or the bond market is going to slow down because the mutual fund, the insurance are start to slow down. So you have to have a reasonable projection. What are the potential sources? What are the trends? Based on these, you can choose which instruments to tap. So that's the step 3, to identify potential sources and what are the costs and the uncertainty associated with different instruments. Step 4 is basically identify the baseline projections, because there's most likely scenario for GDP growth and the fiscal deficit. Then you use that as a baseline projection for your debt, for your MTDS. These baseline projection usually is included in the IMF Article 4 report or the central bank report. So you use this baseline, so projection, say the most likely scenario, what are you going to do? How much funding is required? How are you going to achieve this funding based on different instruments and the projects on the certain structural factors, such as credit ratings? Are they going to be upgraded or downgraded? All these is going to affect the cost of the instruments available for your funding choices. So you also have to look at the effects and the international yield curve to decide on the baseline scenario, what's the funding size, what are the key risks, what are the key constraints. So they use this as a major projection up for the next 5 years. So that's a baseline scenario and execution plan. This baseline scenario has to be inconsistent with the key structural factors. Some of the key structural factors, for example, in the post case, you have to be consistent with the economy's dependence on remittance. right? You have to project the remittance growth, what is it like, because as 30% of GDP could have a huge impact on your debt ability to raise funding. So all these key structural factors, how much concessional financing you're going to get next few years, because a lot of developed economy is also in trouble because the fiscal deficit is rising in these countries. After the COVID-19, they might have less room to provide a concessional funding. But the international financing organization, the World Bank, IMF, they might have more room to provide funding. So this is also have to be considered. Some others, like underdeveloped bond market, that potentially also could be a constraint, structural factor on determining how much bonds you can sell. The development bonds, maybe there's also retail bonds you can. So these are the structural factors. You also have to be consistent with the baseline. After consider the baseline, you also have to consider what are potential risk scenarios, like alternative scenarios. You should also need to consider, just in case the economy got derailed. You also have a contingent plan to do that. You have different ways to find the same level of debt. You can issue more T-bills, you issue more development bonds, or you maybe issue other new instruments, Euro bonds, or borrow in the Chinese or Indian markets. So these alternative strategies also have to be identified based on these different shock scenarios. There could be a shock to your remittance. Say your remittance drops 20%. What are you going to do? What are the potential debt management strategy you're going to pursue in order to meet that challenge? What happens if domestic banks have some problem? What are the contingent plan to raise funding? So all these, you have to consider potential risk scenario and come up with different strategies. So that is additional to baseline scenario. You have to consider alternative scenarios. Of course, the risk and the cost is always a trade-off. If you want to reduce the FX risk, if you don't borrow abroad in US dollars, if you all borrow in local terms, the interest rates cost might be high. If you don't borrow short-term, you all borrow long-term, the term premium might increase in the cost. So there is always a trade-off between the risk you can tolerate and potential cost associated with mitigating these risks. For example, a typical optimal portfolio for a developing country, maybe the FX debt is only 20% of total debt. The refinancing risk is typically can be minimized by extending duration to 7 or 8 years. If you look at some good examples of MTDS, that's like Mexico, South Africa, these are considered like role models for developing countries' MTDS. They typically hedge all the FX risk back to their own currencies because they have well-developed capital markets. They can hedge external borrowing back to their own currencies, even up to 15 or 30 years. But that option is not available to every country. For example, they'd be able to issue bonds up to 30 years. So average duration of their portfolio is typically quite long. Mexico up to 10 years. So every year, the amount you need to raise is relatively small. So you are less subject to the risk of sudden stop. So the choice of risk and the cost is basically based on what's available in the market. How much you can do, what are the costs. So these are the key considerations, cost and the risks. Typical alternative strategy besides the baseline is here, for example, these are the 3 typical strategic objectives when I doing MTDS. The DMO wants to increasing the duration of domestic debt portfolio so that the rollover risk can be reduced. Some countries like Pakistan, they have very low duration. They rely on T-bill to financing their domestic debt. Every 6 months, they have to refinancing. But this is very risky because if there is a shock to the banks decide not to participate in the auction, then basically the fiscal authority will not be able to meet the funding needs. That will be very risky. Also, sometimes the bank's ability to negotiate with the fiscal authority is high because they know you need to borrow desperately every 6 months. The interest rates tend to rise. So the rollover risk, a lot of countries, they want to reduce that. But it's all based on what's available. If the macro conditions are good, investors are willing to buy long-term bonds. They are willing to buy 5 or 10 years if the inflation is low, consistently low, then the market demand for long-term instruments will be high. If the economic conditions are very bad, it's unstable, people expect interest rates are going to go up significantly or inflation is going to go up. No one is going to buy long-term debt. Everybody is just only willing to buy 6 months risk. So it's all related to market development, macroeconomic condition that decides you how much duration extension you can achieve at a low cost. The third achieved strategic objective are usually encountered with the DMO in developing countries. They want to fix the rate long-term bonds. A lot of the even concessional lending or bank loans are related to the LIBOR, like fixed floating rates. Typically, they are LIBOR plus certain spread. So it is a floating rates. It's refixed 6 months, every 6 months. So if the LIBOR rate is fixed high, sometimes they are exposed. Of course, currently, the interest rates risk is relatively low because globally now it's in QE, zero interest rates, and even negative interest rates. So the interest rate risk currently is less a concern. The third strategic objective I usually encountered is a lot of the DMOs, they want to reduce FX borrowings. They realize their local currency tend to depreciate much faster than the interest rates differential between the US dollar and their local currencies. So they end up paying a lot after their currency devalues. So that's desirable for them to reduce FX borrowings. But a lot of countries, they're limited by what's available in the domestic market. So they have to borrow abroad. External borrowings, typically you can borrow a lot at one go. For example, you can issue a Eurobond up to $1 billion. But if you borrow locally, you only can do 50 million, 100 million. You have to borrow many times. The cost of operation challenges is high. So there is a trade-off. If you tap external markets, you can borrow a lot, but you are exposed to this FX risk. In many countries, they don't have instruments to hedge, so they end up stuck with FX borrowings. These examples, for example, like in Mexico in the 1990s, they had a big problem with external borrowing because they think borrowing the US dollar in the short term is so cheap. So they tend to tap 6 months the T-bill markets in the US. But when there is a sudden shock to their economy due to the elections, the local currency suddenly depreciate a lot. External market dried up, so they have to default on the debt. So the effects short-term borrowing, as John said in the New Zealand's case, is extremely risky. So these are the typical 3 strategic objectives to consider when you're running different funding strategies to your debt. Some of the examples when we doing this technical assistance with other countries, you can see that in their MTDS, they put in their MTDS. They, within next 5 years, these are the strategic objectives I'm going to achieve, typically including extended duration of their debt portfolio, reduce their external borrowings, also increasing the share of long-term domestic debt. The best instruments, of course, is long-term domestic debt. 5 or 10-year bonds, that's typically is good for local funding because the cost is locked in and the rollover risk is reduced. So it's a common theme among most of the DMOs, especially the refinancing risk is a main risk for a lot of developing country DMOs. They issue Eurobond in bigger size, but typically in 5 or 7 year terms. But when time goes by, typically they don't have that money to repay. They have to issue a new bond to replace the older bond. So these refinancing risk is very pronounced in a lot of developing country DMOs. So after you evaluated the alternative strategy and you rank all these strategies, then you choose the best strategy and review all these based on the risk cost trade-offs. Then you rank it, then you choose the best strategy you think is most reasonable considering the risk scenario. So you rank these strategies and consulting these strategies with the fiscal monetary authority and the market participants to see if this is really reasonable and feasible. So your choosing optimal strategy is consistent with what the other agency might do. After you choosing your optimal strategy, then you basically get approval from the key authorities, Minister of Financing or central banks. Then you publish it. Then you communicate it to the market participants to convincing them these are the steps you're going to take portfolio risk in your debt. In that sense, you win the market confidence. Then hopefully the participation in auctions or these Eurobond issuance will be increased. The MTDS documents is a key document to communicate to the markets for medium-term risk management. So that's the key 8 steps to produce one. Next, I'm going to make some brief comments on what do we think we should consider when we design the MTDS for Nepal. What are the current key risks in the Nepalese debt portfolio? What are the options and they have in the next 3 or 5 years in order to funding the increasing debt levels? What are the risk mitigation tools they should develop or consider? So overall, we make some of these preliminary observations. Of course, we should be discuss this with you guys in more details. This is very preliminary and initial. I just read some of the documents based on our experience. We make these observations. It's not a final. We should discuss this in more details to see if we agree on some of these things. Overall, I think the debt portfolio risk in Nepal is quite manageable. Is relatively good compared to some of the developing country I worked on. The debt level is quite low, but even though it increased from 2030 now to 40, potentially might increase even more, even if the recovery is weak. But even that, the debt level is below most of the developing countries. Also, the debt portfolio, the servicing cost is also very low because a lot of concessional loans carry very low interest rates. Also, the interest rates in your domestic market is also very reasonably low. Not like some countries, they have a 7 or 8, 9% interest rate. Your interest rates cost servicing relative to government revenue is also very low. So these are quite, comfortable indicators. A lot of these foreign debt is kind of matched with remittance inflows from the Gulf countries, it's all dollars, dollar versus dollar. So overall, I think the risk indicator and the debt levels, debt servicing cost looks reasonable. Is as I examine these debt levels and the split of the debt, external and domestic. External debt level is quite high, is half of the total debt. But I understand because it's concessional, it's low interest rates, long-term with a very flexible grace period. So it's relatively okay. In terms of domestic debt, it's roughly split between development bonds and the T-bills. Development bonds have long tenors. So overall, the average duration of the domestic debt is, my guess is also probably quite reasonable, maybe around 5 years. So the rollover risk is not that bad. T-bills is 1/3, is slightly high as a total share, but it's mostly linked with open market operations. So a lot of them are held by the central bank. So it's also less a concern. So the domestic debt is generally have a long duration, low interest rates. T-bills are held by central bank for open market operations. So overall, I don't see a lot of rollover risk in the domestic markets. If we look at the redemption profiles of external debt, is also relatively smoothed out over many years. So there's no like a lumpy payment in a particular year. Most of these concessional loans are likely to be renewed. For example, if you borrow money from World Bank, ADBs, they typically have a quote for each country. So you always can roll over, borrow a certain amount of money from these institutions. So it's not like after the maturity, they will not lend you again. So concessional funding is most likely will be rolled over. Some of the concern I had is the FX risk, because half of your debt, around 25% of GDP is in US dollars, but you are pegged to the Indian rupees, but Indian rupee has been depreciated constantly in the last decade. The depreciation speed actually is quite high. For example, the rupee was around 40 in the 2011, now it's close to 80 US dollars. So we're talking about a 6 or 7% annual depreciation of the currency. So that will every year adding to 7% to your cost if we spread out. So the total actual cost for your US dollar borrowing is quite high, 7 plus say 2% of concessional, actually it's 9%. So the FX depreciation actually increasing significantly of your external debt burdens. We should think about how to manage this in the future if the depreciation trend of the Indian rupee continues at this rate. That is potentially could have some impact on total debt. Ideally, we needed to produce a table like this. For each scenario, we needed to produce a table like this. So what are total amount of funding? What are the cost of funding? What are the key risk indicators with external, domestic? But because I don't have the data portfolio information, detailed ones from your side, I only make some judgment based on the public information available. So ideally, DMO should produce this table regularly. Every quarter you should examine these key indicators, the cost of the debt, risk of the debt, of the key risks. As some of the general observation about public debt risk in Nepal compared to the peer developing countries, I think overall, Nepal had a lot of strengths to manage its debt. It's a low debt, low interest rates cost, rely on long-term concessional funding, the low interest rates. Domestic markets, you have this development bond with long tenors, also a bigger plus to manage these domestic rollover risks. In terms of structural factors such as size of the banking sector, savings, it also looks favorable. You have very high saving rate. The banking sector is reasonably large. Also, you even develop a sizable insurance sector, potentially a demand for long-term bonds. These are I think will be a big plus. You compare to other countries with low saving, underdeveloped financial sector with no long-term domestic bond market. Nepal actually has a lot of unique strengths despite this relatively low income status. So there is a lot of favorable structural factors for you to deal with the rising debt. But there is some of the risks I also observed, which is relatively unique to Nepal. First of the obvious one is the FX risk. Your currency is pegged to the Indian rupee, but your debt is all denominated in US dollars. So the revenue you collect from your local economy, because it's probably mostly related to the rupees, because your major trading partner, economic partner is related to the Indian. Your economic cycle probably more related to the Indian. So your revenue, the growth of the GDP is on rupee-based economy. Your liability is in US dollar. So that's kind of mismatch. Poses some risk, especially when the rupee has been on a depreciation trend. You have to think about how to deal with this. The other one structural factor that limits public debt management is macro vulnerabilities. The economy is reliant on remittance. Remittance is 30% of the GDP. So you run a very trade deficit, which is financed by remittance. But the remittance could be very volatile. Sometimes, for example, like COVID-19, there's a lockdown in other countries, the remittance income could drop significantly. You have to come up with some contingent planning. For example, if the remittance drops by 15% of GDP by half, because oil price is very low, some of the Gulf countries may not embark too much infrastructure projects. Some of the construction work maybe the demand will be weak. So you have to consider some of these potential scenario. If the remittance drops significantly, how are you going to deal with your debt placement and external debt? The debt trend overall is still manageable, but potentially the fiscal federalism, they might causing the debt pinch. The local government, they might borrow as much as they can. That potentially have to be monitored to reduce potential risk of a sudden rise of debt, because local government now have freedom to borrow more. So some contingent liability, but it's still relatively small. As you said, you are granted 3 guarantees, but some of the credit guarantee to banks, to SOE, as a part of the COVID-19 response, also have to be monitored. Potentially they could be crystallized. So overall thinking is, I think, most of the factors are still quite favorable. The risk is low, but there are a few risk scenarios we have to be mindful, especially the sudden drop of remittance and continued depreciation of the Indian rupee. These are more pronounced potential macro fiscal risks. Some of the suggestion to manage these risks, first is, I think the most important one is to develop a liquid local government bond markets, because you have relatively high saving, big financial sectors. These are all diversity, non-bank financial sector as well. These potential provide a good basis for diversified investor into your countries. Also, macro conditions has been relatively stable. So needed to organize some bond market development committee to develop increasing the size of domestic capital markets. Also, maybe explore the options to issue long-term debt in India to match your liabilities. Instead of borrowing dollars, maybe you borrow Indian rupees at slightly higher rates, but you can reduce that FX risk. Maybe even using some of the options to hedge the FX risk, Indian rupee cross-currency swaps. But that is at a later stage, and maybe you should consider that. Then fourth one, in order to deal with volatile remittance inflows, if the remittance suddenly drops 15%, maybe you should. I think I'm almost finished. Yeah.
What?
I think maybe have a contingent line to the euro bond markets is also good. I think that's pretty much I have on the MTDS, unless you have any questions. Yeah, I think I'll stop here. If you have any questions.
No, sir. Kindly finish your. We are very eagerly waiting you. You can finish. We can wait more 10 minutes if you allow us.
Yeah, I'm basically finished on my side. Yeah.
Okay. So this time, yes, please.
Thank you, Hui, for the good presentation. Just one gentle remind, as Hui said, that these, observations. Sorry. Yeah. Okay. Could you please mute, because I hear some background participants. Yes, just these observations are based on historical data, and we haven't received the latest data. So, as Hui said, these are tentative observations. Some, recommend.